The rich keep getting richer. And that's because many of them are paying little in the way of taxes, if anything at all. In this video, I'm going to explain exactly how that is possible. All the tips and sneaky tricks that the 1% use to stay ahead. I'll also try to make sense of the current discussion around a billionaire's tax and what it means for us, non-billionaires. Spoiler alert, a lot. Before we commence, I must ease the suspense as there's some information I need to dispense. Although I may make you wiser, I am no financial or tax advisor. Please consult your financial or accounting dude before making any hasty moves. Now, with that out of the way, I'd like to say good day to all the new viewers here today. The name's Guy, Crypto Guy, and I'm the hero over here at the Coin Bureau. And it's our mission to lessen the friction you encounter when entering those crypto markets. News, reviews, overviews, anything you choose. If that sounds like something you'd like to avail yourself of, nail that subscribe button. Ping that bell as well, and YouTube shall give you a bell when the next video drops. Okay, that's enough fluff. Let's dive right into all this tax stuff. So, why is there all this talk about billionaires and taxes once again? Well, that's for two key reasons. Firstly, you have the fact that policymakers in Washington are trying to go after this class of people with new tax proposals, and more on that later. But I think another more fundamental reason that it's back in the spotlight is because of the amount of wealth that has been accumulated over the past 10 years by these people. Wealth that has been taxed at incredibly low rates. This was recently brought to light thanks to what is termed the IRS files, essentially a leak of tax information that was covered by ProPublica in June. The leak contained vast troves of IRS data on the tax returns of thousands of the nation's wealthiest people, covering more than 15 years. People like Mark Zuckerberg, Elon Musk, Jeff Bezos, Warren Buffett, you name it. Now, I've linked to the full report below for you to peruse, but here are some of the most illuminating stats. For the 25 richest Americans in the period from 2014 to 2018, their wealth increased by a collective $401 billion. However, during that period, they only paid taxes of $13.6 billion, which would equate to an effective rate of about 3.4%. Crazy, right? And if we were to drill down into some of the richest of this rich list, the numbers get even more crazy. Take a look at this. These are the taxes paid on wealth growth for Buffett, Bezos, Bloomberg, and Musk. Buffett only paid an effective rate of 0.1%. Yep, you did read that right. Paying such low rates of tax, it's no wonder that Buffett has become one of the biggest proponents of raising rates on the uber-wealthy like himself. Now you can see the effective rates are 0.98%, 1.3%, and 3.27% for Bezos, Bloomberg, and Musk respectively. Another really interesting graphic from this report is this one over here. It compares wealth growth and taxes paid by Bezos and the average American family. That noticeable dip over there is the fact that during the 2008 recession, many families lost their homes, where the bulk of their assets were. Bezos mostly owns stock, and he definitely was never foreclosed on. Now, the point here is not to shame these billionaires. They have built successful companies, and capitalism rewards risk takers. Moreover, it's also worth pointing out that all these folks have been paying what is legally owed. They have been doing what any rational person would be, using the tax code to their advantage. But what this report does highlight is the fact that the burden of proportional tax is borne much harder by those less well off. And the reason for that is because of that very tax code. So, let's take a closer look into these magical codes of which I speak. Before we can delve into the specific tactics used by the rich, we have to explain exactly how most of them make their money. That's because the way that they make money will impact the type of taxes they'll pay. Now, most people will pay an income tax on their income. This is mostly on your primary source of income, and in the case of most of society, this is their salary, their monthly paycheck. Now, this income is taxed at different rates and goes up to 37% at the US federal level for the highest tax bracket. Now, quick side note, to simplify the examples in this video, I'll be looking at US taxes, although the practice is broadly the same in a number of countries. I'll also be looking only at federal rates, as states and local governments will have different rates. Anywho, this income tax is usually hard to avoid, as it's taxed when it's earned and in many cases is taken out of your paycheck as payroll taxes. However, when it comes to the uber rich, they own assets that when they appreciate are taxed as a capital gain. However, long-term capital gains tax on gains for assets held for more than a year, are much lower than income tax. For example, in the US, the top rate of tax for capital gains is 23.8%. This is much lower than the top rate on standard income. In fact, based just on the raw percentage here, that would be the same rate of tax that's paid by someone who earns between $86K and $164K. So you can now see why so many of these billionaire founders of companies choose to take token salaries. Bezos earns a measly $80,000. Steve Jobs famously took a $1 salary. Mark Zuckerberg and Larry Ellison have followed suit. Now, by doing this, they're avoiding having to pay any income taxes at all. They are taking stock and options on stock that will only be taxed at the capital gains rate, over 13% lower than they would have paid should they have opted to take income. But here's the really important point. This capital gains tax is only due once the gain is realized, i.e., sold. They are not obligated to make this sale in any way, shape, or form. They can literally hold on to these assets for a lifetime and never pay tax on them. In fact, that is exactly what most of them do. But I know what you're thinking. Guy, how can these guys afford to live without realizing those gains? Well, let me tell you. Now, there's a common misconception out there that rich people try to avoid debt. It's actually quite the opposite. They are among the most prolific users of it, and they do it in very smart and efficient ways. One of these is through borrowing against their assets and living off of borrowed money. They're using their vast assets as collateral in order to take out debt. Now, the reason that they're doing this is because they don't have to sell those assets and realize that gain. They can avoid paying any taxes on the vast appreciation in their wealth and still live like ballers. That's because of a tactic called buy, borrow, die, and it should be fairly self-explanatory. I've already explained the buy part of that. They accumulate valuable assets that can be used as collateral, assets such as stocks, bonds, real estate, art, etc., etc. Then, once they have these assets, they move on to the next step and they look to borrow cash using the assets as collateral. Now, while this may sound similar to a home equity line of credit, it's much more favorable than that. When we apply to get credit and use our houses as collateral, we usually have pretty onerous terms. We have higher rates of interest, and the amount of credit we get on those homes is limited. However, if you offer a bank highly liquid securities as collateral, you can get an absolute bargain. According to this piece in the Wall Street Journal, some of these lenders don't even need credit reports. Goldman Sachs' private bank has even offered securities-based loans on anything from $75K to $25 million with, quote, no personal financial statements, tax returns, or paper applications. When it comes to interest rates, Merrill Lynch quotes 3.2% for those with assets of over $1 million and as low as 0.87% for those with assets of over $100 million. Those are rates of interest and terms that we could only dream of. Then, once they have this cash, they can do with it what they want. Yes, they have to pay interest, but as we can see, it's really small. Moreover, the values of their assets usually appreciate more than the rate of interest. This is termed positive carry, where they end up better off than they were before. Oh, and here's the real kicker. Interest on loans is tax deductible. These interest payments can be used to offset their already low tax bill. And of course, they don't really ever have to pay this off. The banks are okay with them rolling it over into perpetuity. You get to live your best life and still retain the upside on all those assets. Now, why is that, you ask? Well, it benefits the banks to have such high value collateral. It's easy to liquidate, unlike houses, and the bank itself can earn high returns on those assets, a process called rehypothecation. Most of the nearly 1,000 richest Americans use this tactic. For example, Elon Musk and cable billionaire John Malone have pledged $150 billion of their stock for loans. Yes, there is the risk that the stock collateral falls in price and that these billionaires will get a margin call. But these assets generally tend to appreciate, especially with all that money printing going on at the Fed. Thanks for that, Jerome. Now, there's a lot of accumulated capital gains sitting out there. By some estimates, it's as large as $5 trillion. This is wealth that has never been taxed and, in some cases, never will be taxed. That's because of the final step required of these billionaires, which is to die. When these billionaires with so much wealth do eventually die, they leave that wealth to their heirs. They may have outstanding loans that are then paid off by these heirs. However, they keep the assets. Yes, these assets may incur an estate tax, but there are a number of strategies around gifting, donations, and charitable foundations that lessen this burden. But that's irrelevant, really, when you consider the fact that these heirs won't have to pay those accumulated and unrealized capital gains. This is thanks to something called, quote, step-up basis. Essentially, when people die and their heirs inherit their fortune, the cost of the investment in the eyes of the IRS is the value of the asset that they received. So, as a hypothetical example, let's assume Guy Rockefeller over here built a crypto empire in the metaverse. He got shares in the Coin Bureau company and never sold them. The cost of those shares when he got them was $0. These shares appreciated every year and quite literally went to the moon in price. Now, being the die-hard hodler that he is, he never sold. So let's assume Guy's value of the holdings in Coin Bureau company became worth $100 billion on his deathbed. That means the accumulated capital gains tax is effectively $27.5 billion. However, once he dies and passes those assets on to his heir, the cost of those assets for the purposes of calculating capital gains is the market value, $100 billion. So, for example, let's assume that Guy Jr. over here holds that $100 billion for more than 1 year and decides to cash out. The value of the portfolio was worth $102 billion at the time of sale. That therefore means the gains which are taxable are $2 billion. He is only due to pay a total of $540 million on it when it should have been $27 billion. Now, of course, this is a simplified example, but you get my point. This is how some family dynasties have been able to hold on to their wealth for generations. They are able to pay legions of estate planners and accountants to structure the most sophisticated of vehicles that are beyond the reach of us mere mortals. Now, of course, this has not escaped the ire of many progressive politicians, and it has now emerged front and center of the debate around billionaire taxes in the US. This is thanks to a new proposal by the Biden administration to come after these unrealized gains. So, let's take a look at that, shall we? If you've not been following the drama on Capitol Hill recently, let me spare you the boredom. Basically, the Democrats are trying to pass a massive spending bill. The fight over this bill has been going on for months, back and forth and round and round. Now, irrespective of what the bill will finally contain, it's clear that part of the effort to pay for it involves taxing wealthy individuals. For example, back in May, the initial target of the bill was the capital gains rate. Aware of the fact that CGT was much lower than income taxes, the Democrats proposed increasing the top rate for CGT to 39.6%. If you include the Medicare surtax, that would take it to 43.4%. Pretty damn punchy. Now, as you can imagine, this was a tough sell. Firstly, it applied to anyone who has over $1 million in income, which is a much larger subset of people than just billionaires. Moreover, if you include state taxes to this, it would take an effective tax rate of over 50%, 52.5% in New York or 56% in California, for example. So clearly a hard pass on that one. So the Biden White House came back with this proposal to tax the unrealized capital gains of some of the richest Americans, a much smaller subset of 1,000 people who, in a polarized world, tend to be easy targets. However, it had the opposite effect. The notion that the government would come after unrealized gains sounded a hell of a lot like a wealth tax. In fact, that's how it was marketed to some progressives. Janet Yellen had to go into damage control mode on various TV shows to explain that it was merely a capital gains tax on, quote, liquid assets held by extremely wealthy individual billionaires. I wouldn't call that a wealth tax. Now, of course, she can massage the wording as much as she wants. It was a tax designed to go after the wealthy for their unrealized gains. a tax that many legal scholars said may even be unconstitutional. But it's not what you term it that was controversial. It's the whole concept itself. Who would determine whether an asset was sufficiently liquid? Where do you draw the line? And if you do draw the line, would this discriminate against some billionaires in favor of others? Would those billionaires who have most of their wealth in stock have to pay that unrealized gain tax while others who own land don't? It's not really that sensible. Or what about if these billionaires have to pay that tax in 1 year on a gain, but the next year there's a loss? Are they not entitled to a tax refund on the back of that loss? Will the IRS pay that out? What about if some of the most ultra-wealthy have to sell their holdings in order to pay these taxes? What impact could that have on the broader market? Assuming someone like Elon Musk or Jeff Bezos had to sell tens of billions worth of stock in the companies that they own, would that not have an adverse effect on the stock market? A stock market that millions of middle-class Americans are invested in with their 401ks. All of that for a mere potential tax benefit of $250 billion. Now, we don't actually have to be asking these questions. We have evidence of how these wealth taxes have worked in the past, and for that, I turn to Europe. In 1990, there were 12 European countries that had a wealth tax. However, today there are only 4. Now, one of the most recent casualties of the wealth tax was France, which scrapped it in 2017. This has provided a useful case study in order to analyze the real effects these wealth taxes have had. In the case of France, since the 1980s, it had had an annual wealth tax on all those individuals who had over 1.3 million euros in assets, not a high bar by any stretch of the imagination. The first and most obvious impact that this wealth tax had was that it drove the billionaires out. There was an exodus of wealthy people from France during the time that it was in place. For example, by the Prime Minister's own estimate, some 60,000 people with 35 billion euros worth of assets left between 2000 and 2016. This is because billionaires are the people who have the most means to move their tax domicile. They can easily move to more friendly regimes, and in the case of France, that was next door in Belgium. Just ask Europe's richest man, Bernard Arnault. Now, apart from this, the wealth tax was incredibly hard to enforce and thereby costly as well. In fact, according to French economist Eric Pichet, the cost of administering the tax was twice as much as was brought in. Just think about that. The country's fiscus was not only worse off than if it hadn't gone after this tax, but it now had even fewer billionaires to tax in the first place. Many of the other countries in Europe came to the same conclusion. The administrative burden just didn't make much sense. There were so many exemptions and loopholes that the rich could almost completely avoid it. Then, of course, there were the impacts that this had on general investments. Now, despite what most people tend to think about billionaires, their investments do help to fuel innovation and economic growth. This was exactly the reason given by the Austrian government when it eliminated its tax. It placed a, quote, economic burden on Austrian enterprises. In the end, Europe got a real-life practical example of the Laffer curve. This is a well-known economic theory that shows the decreasing marginal returns of taxes. You get to a point where increasing taxes brings in even less revenue. Now, I'll leave all of these research papers in the description for you guys to read through at your leisure. They are remarkable case studies on the real-world side effects of these policies. The TLDR is that it's easier to say tax the rich than it is to actually tax them. Well, that's it for most of my video, but I did want to close with a few personal thoughts here. During a time when the pandemic destroyed our economies and pushed millions into unemployment, the rich got even richer. Not only that, but they managed to accumulate most of that wealth without having to pay their fair share of tax on it. Naturally, this has led to a backlash from the populace. It feels just so inherently wrong about Warren Buffett paying 0.1% on his taxes while his secretary pays over 37%. And, to Warren's credit, he has been the one to point out this disparity. However, having said all of that, the alternatives don't sound too appealing either. Taxing unrealized gains is a recipe for potential disaster that could bog the IRS down for years. A proposal that the rich would fight tooth and nail and which could be proven to be unconstitutional. General wealth taxes have also been shown to be highly ineffective when implemented in European countries. Their impact has been to make governments and citizens poorer, while the rich simply up sticks to other, more favourable jurisdictions and enjoy their wealth there instead. There are also some who argue that we shouldn't be taxing success. If you disincentivize someone enough, then they will reduce their economic output. That's the Laffer curve I talked about earlier. Me personally, well, I know I would be really angry if the government wanted to tax all the gains on the Bitcoin that I'd been hodling. Bitcoin that has not been sold and that I don't intend to sell. I know many homeowners who feel the same about their houses or apartments. Does this mean that the billionaires who own stock are not allowed to feel similarly angered by the proposal? It's a tricky one for sure. Now, the fact remains, though, as pointed out by the likes of Joseph Stiglitz and many others, that inequality is a blight on our society. Tackling inequality would make life better for billions of people and supercharge the world economy, yet it's easier said than done. Perhaps instead of targeting the wealthy individuals at the top of the pyramid, it would be better and fairer to go after the corporations that have made them rich in the first place. The corporations with billion-dollar profits and tiny tax bills. The corporations that offshore their income and, in many cases, treat their workers appallingly. Individual enterprise should be allowed to flourish, but corporate greed is a much more insidious and damaging force in the world. So let's go after that instead. Now, folks, what are your thoughts, though? Do you think there's an alternative to simply taxing the rich? What are your thoughts on the unrealized gain proposal? I'd love to know, so fire those comments down below. Now, if you don't have a comment, that's cool, but you may also be interested in my socials page. This is the page where I share exclusive content that you're not getting here. This includes my Telegram Insider channel for daily market analysis and thoughts, as well as a daily selection of interesting news articles that I've been reading. My Twitter for announcements and the occasional shitpost. Instagram and TikTok for behind-the-scenes views and memes. And lastly, but definitely not least, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. It comes once weekly as well as with a spam-free guarantee. And it's also completely free, folks. Sign up, receive once weekly email, read and enjoy once weekly email, and that's it. Cost to your good selves, 0. So why not have a butcher's, as they say here in London? Now, the links to all of the above are in my socials page below. Oh yes, and if you liked this little number, then you can pick it up in the merch store. All sales go to help keep the channel ad-free, so thank you in advance for your support. That's also in the description. You can't miss it. And finally, if you found this video helpful, slap a like on it. Subscribe and ping that bell as well to make sure you never miss another one. Time's up for this guy, but I'll be seeing you guys very soon. So, au revoir, auf Wiedersehen, adios, arrivederci, ahoy, do widzenia, goodbye.